Jeff Davenport from CUNA Mutual Group. Apologize for not being able to do this session live on the 29th, but thought I'd record it and get it out to everybody so you can have an opportunity to listen to it and maybe share it with, maybe make it part of your strategic planning session if you haven't done your planning session yet. So I'm going to focus our time today on looking at overall economy, what's happening in the industry, and what's happening in Vermont and in the surrounding geography. This is something you could take a look at your leisure. This is just a breakdown of a lot of the growth projections that Steve Rick and Mike Shank are thinking we're going to experience through 2022. I've got some slides coming up that'll show that. Economic growth. You could see we had 2 consecutive years after the Great Recession of economic decline. We only had 1 year of that economic decline coming out of the recession we had in 2020, because back in 2009, that was a financial crisis, a financial recession. 2020 was a health crisis, a health recession. So, and the federal government was a lot quicker to get money out into the hands of consumers to stimulate some growth. Now, the Fed target is 2%. Now, there's a back and forth going on now about inflation. And I think what's happening is, again, the definition of inflation is too much money chasing too few goods in the economy. And we're at that because we have this supply chain disruption that is slowing the products and service, or the products getting into the marketplace. So that's creating higher prices. So people sitting on some pent-up demand, sitting on some liquidity, ready to spend it, but the products and services aren't there. So, but I think we're still going to be right around that 6 to 7% range as it relates to growth in 2021. And you could see that the expectation is once the Fed starts making some moves, which depending on who you talk to, those moves could start in 2023 or 20 through 2022, or they might not make any moves until 2023. So trying to get that inflation down, or that growth down, closer to that 2% target that the Fed has always had. So, and then we continue to have these variants of COVID, different variants hit us, and that's impacting what we see for growth and what we see for consumer confidence. This week we saw 2 days in a row for the first time in a long time of the Dow dropping significantly. So it's starting to come back, but just the news of that variant coming out of South Africa really had some big impact on the stock market. Unemployment 4.8%. We look at that from a national perspective. I always say that's only reporting those people who are still actively looking for work and actively reporting to the Unemployment Bureau. That doesn't take into account those people that have just stopped looking and they're no longer reporting to the Unemployment Bureau that they are still looking. They're not receiving unemployment benefits. They're not reporting into the Unemployment Bureau. I usually have like a 1.5 to 2% buffer, and I think Steve Rick kind of has the same thing. So I think you could easily say, with that said, unemployment is probably closer to maybe 5.5 to 6%. Now, you wouldn't think that would be the case when you look around Main Street and you see all the help wanted signs. So we still have some employment issues out there. Vermont right around 2.8% unemployment through September. Your high point was right around 14.8%. So you have significantly dropped unemployment levels well below what the industry, what we've seen nationally. And typically unemployment and delinquency have tracked together, with the possible exception of coming out of 2000, 2001. But especially here, delinquency stayed very low as unemployment spiked. And that's because of the loan forbearance programs, the stimulus checks that were out there, the enhanced unemployment benefits, a lot of the things that either you as a credit union or the federal government did or state governments did to help stimulate the economy, help put money in the pockets of consumers and help consumers with payments and to help them from not going delinquent. We saw a lot of that over the last 18 months. That's why delinquency didn't spike the way it has in the past. U.S. vehicle sales, again, it's a supply and demand issue. It's being impacted by the supply chain disruption. We started out with the chip shortage. So we're having a tough time getting inventory onto the dealer lots. You could probably see that by driving by a lot of dealers in Vermont, and you see that there's not a whole lot of inventory on their lots right now. They got quite a bit of used inventory, but they don't have a whole lot of new. So we're on pace to right around 12.2 million. And what our long range average has been 16 and a half. So we're about 4 million units off the pace of where we typically are. But Steve and Mike seem to think that by the time we get to 2023, we're going to be back to the levels that we've been at in the past, between 16 and 17 million units sold. Existing home sales, the inventory is still tight. It was tight when we came into COVID, and it's only gotten tighter because of the inventory hasn't changed. The inventory is still the inventory. What's changed is the demand and the people, out migration of people out of the cities into the rural areas, rural pockets of the state, of the country, has put even more pressure on prices of homes. So home prices have gone up about 13%. They were down 10% after the Great Recession. So there's going to be some pressure, and how this impacts credit unions is going to be, when we think about loans, are your policies too restrictive in this environment? Take a look at your loan policies around any sort of underwriting changes you could make. Any sort of is the duration, the term of your loans limited, where you only go, say, 72 months. And most people now are looking beyond 72 months for a payment, because again, the supply and demand is raising the price, and consumers are looking for a longer term loan so they can afford the payment on that new vehicle or on that home. Your loan to values, are those too restrictive? Because these values of these vehicles have gone up because of the price, the pricing, and as well as housing. Now, you can't go 100+% financing on a mortgage. We don't want to do that, and I'm not saying that. But are you a credit union that has a private mortgage insurance program in place where you can help the first-time home buyers, and you can help some of those people create that opportunity for them to buy that home and not have to come up with a 20% down payment on a home that's at market value and above? So taking a look at your policies just to see, are we in a position to lend money in this environment, especially if you have the net worth to be able to fall back on, to be a little bit more aggressive, a little bit less risk averse, and take on a little bit more risk and mitigate that risk, obviously, but take on a little bit more risk when it comes to underwriting loans to your members. Now I'm going to be getting into these one by one, so I'm just going to skip past this. Share growth. This has been a big issue for every credit union in the country. Share growth, over 20% last year, about 15% this year. We're looking at that's going to probably level off to about 5% over the next 2 years. And that's really been funded by the money, the stimulus money, the enhanced unemployment benefits, the things that have been coming into the marketplace to help create and stimulate some consumer confidence and consumer spending. What I would say on this slide is, while I say that, I mean, I'll bring up your Vermont, what's happening in Vermont and New England and the Northeast. So you can take a look at that. What I would say is, as you look at your ALM policies and you look at your ALM strategies, look at those rate sensitivity factors. Where are those set? Are they set in a way that you would be more aggressive in following the competition to increase rates if rates when rates do go up on the deposit side? Or are you going to be a little less aggressive and maybe hold off and create a little bit less of an increase to match dollar for dollar or rate for rate and take a little bit longer to do it? So rather than pull the trigger and do it within 30 days, if your competition does it, maybe waiting 3 months before you do it. Those are the types of things I think credit unions are going to have to look at, because I don't think we're in a position right now that we want to be and always want to be the top 3 or top 4 rates in town as it relates to CD rates. And I know that's tough for credit unions to swallow, because we always want to be the highest rate in town. That's what we were built on. But I think we really have to look at the income statement when we're making those decisions as to when we're going to increase rates and by how much. Because by doing those things are good, but there's only a small percentage of your membership that's going to take advantage of those higher rates, those more affluent members, the baby boomers, the people saving for retirement. You're going to have quite a few other members who don't have that money to be able to put into a CD. So you got to really look at it from the standpoint that how is this rate increase, when we do it, how much we do it, I think needs to be taken into consideration as it impacts the entire credit union financials and all credit union members as we move forward into this environment. Because what that's done is it's created some lower loan to shares. Again, 15% share growth this year. So that's driven down. I mean, we were the highest level of one of the highest levels of loan to share that we've been at in a long time, back in 2018. Now we're looking at about 70% at the end of this year, and that will come back to just shy of 72% in 2022. And you're right about, you were up around 90, almost 93% in pre-COVID. And you've come down to about 79% through the first half of 2021. But again, everybody's in that same situation. That's created some net worth. Asset growth has accelerated, and asset growth has been so much that it's happened faster than what you've been able to do to put that money to work. You've got a ton of money sitting in overnight accounts. You've got money in the short-term investment portfolios. You're lending in the mortgage loan environment. So the loans that we're doing, the investments that we're making, our cash levels are not getting a whole lot of return. And loan growth, again, is down. So investment growth has far exceeded loan growth. So our ability to generate the revenue necessary to maintain net worth at its current levels has been impossible. So we're looking at about a 10% net worth in 2021, and that'll kick back up to a little over 10% by the end of 2022. And you can see this is what's happening in Vermont, 9%, just shy of 10%. Now, the good news here is in Vermont and across the Northeast and New England, net worth drops have not been that serious. We're only looking at about a 1% drop, where I've seen some areas where credit unions are dropping 200 to 250 basis points year over year in net worth. That yield on assets is really what's impacting. 2.9 as an industry. 75% of that drop is due, 39 basis points is due to just the rate environment that we're in. And 12 basis points or 25% is the mix. The money, we're putting money into short-term investments. We're putting money sitting in the overnight accounts. And again, the loans that we're doing are not high rate type of loans in this environment. So, and consumer confidence has been down, and loan growth overall hasn't been all that great. So that's really been impacting the whole average yield on assets. So we've got some loan growth numbers that, we're looking at 5.3, 5% this year, back to 9% next year and the year after. I'm not quite as optimistic at 9% loan growth in 2022. I don't think it's going to be, I'm guessing more around that 6 to 6.5% in 2022, because I still think we're going to have some carryover of low consumer confidence as it relates to the COVID variants, as it relates to consumer confidence. I think there's going to be some things that are going to impact us. Also, the loan growth that we experienced in 2022 or 2020 and 2021 were real estate loans and PPP loans on the member business loan side. Those are not going to drive loan growth in 2022 unless you get very aggressive with first-time home buyer purchase money mortgages. Your real estate portfolio isn't going to grow because those who want to refinance in this environment probably have already refinanced, and the PPP loans are done. As a matter of fact, those are going to be coming off your books because the forgiveness of those loans are starting to hit credit unions now from the SBA. So those are going to start to run off. So that's why I'm not quite so optimistic that we're going to see 9% loan growth in 2022. Now, like taking a look at the whole digital, are you doing anything on the digital side to make borrowing money more convenient for your members? I think that's a critical piece. Either partnering with somebody, collaborating with somebody, be able to do that. Steve Husick has a slide. I don't know if you've seen Steve's presentations before, but Steve has a slide that shows the past few years of bank customer satisfaction versus credit union member satisfaction. And credit unions have always exceeded banks as it relates to customer satisfaction, with the exception of the last 3 years. Banks have surpassed credit unions, not because the tellers and the new accounts people and the branch managers are so much nicer than our people in credit unions, but it's because the banks have been more aggressive in getting digital delivery of products and services out to the consumer. That's the only reason. And they haven't done it because they've got smarter people than we do, and they're building it within their own four walls. They're going out and they're partnering with fintech companies. Goldman Sachs partnership with Marcus, and they built that through a fintech to be able to do online lending 24/7. So those are the things that have really been impacting that customer satisfaction score. So I'll go back to what I said before, that whole review your underwriting policies. Are they too restrictive in this environment? Are they prohibiting you from being able to help those members that need help and create that organic loan growth that you need? Because it's going to be hard to get that new money, people coming through the door type of loan growth probably over the next 6 to 12 months, I think. Are you looking at ACH reports to find out those members who have money being pulled every month to go make a loan payment somewhere else? Take a look at the ACH reports and make some outbound calls to those members. If you're doing online lending, take a look at the list of abandoned applications to see how many of those applications can we go back and try to recapture? Why were they abandoned? What did we miss? If for nothing else, it will give you some key learnings as to why you're losing applications in your online channel. This is where the mix has been with credit union growth. And again, it's been in member business lending, and it's been in first mortgages, and it's been in used auto, because new auto's been down because of that whole supply and demand. We had used automobiles. We knew there were going to be more used automobile financing pre-COVID because of all of the leased vehicles that were coming back into the marketplace. They were being turned in. The leases were up. They were coming back to the dealerships. So we knew there was going to be a big supply of used vehicles coming into the market. So that's really part of what drove, no pun intended, the growth in automobile loans over the last few months, according to NCUA and CUNA. This is what you saw for loan growth in Vermont through mid-year, and what the peer group. So you really have done since 2019, you've been pretty much double or triple loan growth in your state versus compared to New England and compared to the Northeast. A lot of it's from real estate. You could see just how much real estate growth you've had compared to the peer groups. Consumer loans, you're down year to date or through the first half of the year. But that's because a lot of your loan growth was coming from real estate loans over the last 18 months. And then remember, business lending was also a big part of your loan growth. And again, I'm assuming PPP loans in this case. Real estate to total loans, I'm sure our friends from NCUA are going to start looking at this. They're going to start getting a little bit nervous around interest rate risk and what that all means. Percent of long-term assets to total assets. We'll take a look at that in a second. But the whole penetration of those long-term fixed rate mortgages compared to the rest of the portfolio. Vermont has always been over 60%. The entire New England has been traditionally above 60% because we're real estate lenders in the Northeast. That's what we do. And that's why we have such a higher percentage, because we do much more real estate lending than we do. And you also have some of the member business that used to be categorized as member business loans that no longer are defined as a member business loan with the new NCUA regs also in this bucket as well. So what that's going to lead to is that whole interest rate risk exposure. Now, the one thing that I really feel that I didn't have to do, that I regret doing when I was CEO of a credit union down in Massachusetts, when we came out of the Great Recession. So here's when we come out of the Great Recession. We were one of those credit unions that had 70+% of real estate loans to total loans. NCUA continued to pound on us. You got to sell new mortgages. You don't keep them on your books. You got to sell them. Rates are going to go up and you're going to get stuck with a ton of long-term fixed rate mortgages. And I know I'm preaching to the choir here because you've probably heard the same speech verbatim from NCUA. But all those years that they said rates were going to go up, and we think about long-term assets to total assets, nothing happened. So I regret following that, letting them, and I hate to use the term bully, but letting them bully me into selling new originations because I sacrificed net interest income for servicing income. So looking back on that, I wish I would have been more forceful and said, no, I'm not going to sell those mortgages because here's the data. Of course, I didn't have this data. I mean, this is Monday morning quarterbacking right now, but being able to show the data points that we came out of a financial recession and this is what happened. And so you can't tell me that coming out of a health crisis, that we're going to see anything different or worse than what we've experienced since the Great Recession. In all credit unions, I mean, Vermont, you're through mid-year, you're just shy of 48%. Everybody else in your peer group or in the area is right around 40. So you're a little bit higher than that chart that I just showed. But again, it all gets down to what's best, like I said, with the share growth. What's best for your own balance sheet? What is your risk appetite and how much of that risk can you take and be able to mitigate for that risk? And that gets us to our lowest margins ever, 2.55%. Because of all of that growth we experienced, real estate growth, lower investment rates. So we got some of those investments maturing, and they've been maturing now for the last 12 months that we were getting pretty good rates on. And we've got to reinvest those into shorter, lower rate, overnight account type of investments. And the only thing that's really helped us in this case is cost of funds has remained relatively low because of people leaving their money short and leaving it liquid. The margin in Vermont, just shy of 3%, but you've always been over 3%. So my guess is if we were to annualize this out and we get to the end of 2021, you're probably going to be closer to that 3% because you ended 2020 right around 3%. So, but everybody else less than 2.5%, but they've always been below 3%. So Vermont has done a pretty good job from a margins management perspective as it relates to average assets. Now, the other thing that's influencing some of these, if you think about any ratio that is being calculated from an average assets perspective, might be a little bit influenced by, again, that accelerated asset growth that we've seen over the last 18 months or so. Average loan rates down to 4.1, 4.2%. Again, that's because of that whole real estate loan growth, bringing those rates down. The refis repricing your balance sheet. Those 5% mortgages getting repriced at 3 3/4 or 4%. That's really what's happening on most credit unions' balance sheets. And then the investment portfolio, 2.5% pre-COVID on average. Now we're down to less than 1% from a peer group perspective. And like I said, cost of funds really has been the saving grace. The money that members have put into the credit union has stayed in those low rate, liquid types of deposits. Fee income, 0.42%. I mean, again, that's down to the lowest level it's been since 2000. A lot of that has to do with a lot of the waivers of fees that you went through from based on some of the NCUA guidance, waiving NSF fees, waiving late charges. That had some impact on fee income. So you did what credit unions do best. They stepped up and they helped their members, and they waived those fees. Credit unions typically and traditionally have always been very member friendly when it comes to fees. The abuse fees are one thing, but just charging fees for the sake of fees isn't what credit unions typically do. So you're about 69 basis points of fee income to total income to average assets. So you're running twice of what the rest of the region's doing. So I'm not sure where that's being generated, but you're doing a very good job in generating that revenue. Now, whether that's coming from NSF courtesy pay programs, the credit union that I'm involved in now, we have seen. Well, I've been preaching now for a year that we're going to see a decline in NSF and courtesy pay revenue. When I look at our programs that's being managed by Pinnacle, we're not down. We're actually up through December or through November of this year. So people are still bouncing checks, and they're still taking advantage of the courtesy pay programs. And I'm guessing that's what's happening in Vermont as well, is the courtesy pay programs. Other income, 90 basis points to average assets. Real estate origination fees have driven that, service retained. Debit card interchange because of the stay-at-home orders. Many people using those debit cards and using those and generating that interchange revenue for you. If you've got some wealth management or insurance type of programs, that could be helping. But mostly what we've seen has been real estate servicing income and debit card interchange. And you're 80.86% through June of, so again, you're well above the peer group as it relates to as other income to average assets. Now, this is a chart that my peer and I pulled together, surveyed about 70 maybe credit union across the country, different sizes, went to them and said, okay, here's what are your non-interest income GL buckets, and what is the percentage of those, how much are you generating in each of those buckets? And this is where these percentages come from. So what I want to point out here is over 50% of non-interest income is being generated in 4 buckets. Courtesy pay was already declining pre-COVID. It was 34% in August of 2019. It went down to 24% in December. And it was through September of last year, it was at 13%. Debit card held on. Credit card declined because when consumer confidence is down, typically credit card usage goes down. because people are going to use the debit card first because they know they've got the money to cover the purchase. With a credit card, they struggle with buy now, pay later because they don't know if they're going to have that job and be able to make that payment. So we see credit card interchange fall off a little bit. This is that servicing income. All of that real estate refi business that you saw in 2020, that's where that came from. Now, debit card interchange. Is it sustainable? Can you continue to count on debit card interchange and credit card interchange to drive your non-interest income moving forward? I'm one that says maybe not to the level that we've been used to, because even before COVID, we had retailers trying to move people from using your debit card at the point of sale and using their in-house financing. Sign up for our Lowe's credit card today and you can save 10% and get no interest for 6 months. So people are signing up for that card rather than slide your debit card or your credit card into the point of sale. The other thing that's happening is this whole mobile wallet. And how do we get our members to put our cards first in that mobile wallet? So when they pull up that mobile wallet, it's our card that's coming up that's going to generate that income, that interchange. So I think that's going to be a challenge from a marketing perspective to keep that debit card interchange running. And what are the opportunities up here? Do you have a wealth management program that you could leverage more? Do you have an insurance program, whether it be life and auto and home or payment protection? These are, this is an area, regardless of who you have this with. I talked about taking on more credit risk. What better way to take on more credit risk? Get a higher score, get a higher rate with your risk-based pricing tiers, because you're going a little bit deeper with your members, and then mitigate that risk against loss of job or collateral damage, whatever it happens to be. Mitigate that risk with this insurance and generate non-interest income at the same time. And you're protecting the asset, you're protecting the member, and you're able to help that member all in one transaction. So taking a look at those different ways to increase wealth management. We've got a ton of money on our balance sheet. People waiting to get better rates somewhere. If you have a wealth management program, are we making those cross referrals to get those members to talk to whoever the advisors are in our wealth management program to move that money into their program? Now, I know that we hate to see deposits run off our balance sheet to a wealth management program in some cases, but at the end of the day, think about the alternative. If you don't increase rates on the deposit side at the highest levels that maybe some people down the street are, that money's going to leave you. That relationship's going to leave. Whereas if you do it and try to get them over into wealth management, the money comes off your balance sheet, but you don't lose the relationship. So being able to leverage those things, I think, are going to be important. I talked about delinquency already. Let me go to, this is what's happening in your state and in the area. Here's my glass half empty approach or comment to this. I know that we're at lower levels of delinquency, and a lot lower than what we thought we were going to be at when this whole thing started. Here's my fear. Those members that were in your 30 to 59 day bucket of delinquency pre-COVID, and the stimulus money, the enhanced unemployment benefits, everything the government has done to help consumers has been that Band-Aid that's helped them stay afloat through COVID. My fear is how many of those people in that 30 to 59 day bucket coming out of COVID are not going to be able to make the car payment, the house payment, the credit card payment. That's what I'm fearful of, because I know when we came out of the Great Recession, we didn't have an impact of delinquency immediately. We didn't have people start coming in with the keys to the car and the keys to the house until about 15 months after the recession ended. I hope I'm wrong. I hope I'm way off base here, but I don't have a lot of confidence in the levels that delinquency has fallen off to. I'm not quite as, again, hopefully I'm wrong. Charge-offs, again, I mean, we haven't charged anything off. And average loans have been down, so we haven't really seen a whole lot there. The provision account, 0.05. When we got to a point of when COVID first started, we were looking at close to this 1.11% of provision for loan loss to average assets. But because we haven't seen the impact of delinquency, the impact on charge-offs that we thought we were going to see, we're now projecting 0.05%. And again, as I said before, the main reason is it's not a mortgage crisis. Home prices are up 13%. In 2009, they were down 10%. And that's been the biggest difference. And you can see where Vermont is compared to the rest of the area. And this slide deck will be available for everybody too. So operating expenses, this is one of those areas where I think this was as much accelerated asset growth impacting this ratio than it was credit unions drastically cutting operating expenses. Now, operating expenses did increase in some areas. Technology, certain things you've had to do with plexiglass and all the things you had to do to fit that your branches to be COVID ready and be very protective of the members and your staff. The money you had to spend there, the money you spent to move people to a remote environment, that was all cost to the credit union. That was all upfront cost. Now we're looking at this whole talent management piece. How do we reallocate expenses and work more operationally efficient to be able to allocate more money towards talent management, salaries, benefits, remote work, those types of things that will factor into your ability to recruit and retain good employees. I think those things, I think talent management is probably going to be one of the biggest challenges for credit unions in the next 1 to 2 to 5 years, and from my perspective. Technology is one thing, but talent management is something totally different. You're dealing with the psyche of an employee and what makes them tick, and sometimes it's not always money, and we sometimes assume it's different things. But I think figuring out what makes people happy so you can keep them, you can recruit them and keep them, I think is going to be a big challenge. And I always tell credit unions, in this environment moving forward, you're going to have to make talent management part of your culture moving forward, because you're going to have a ton of people retiring. And my credit union right now, we've got 1, 2, 3, 4. We got 4 people in key management positions that are retiring over the next 3 years. So that's a big challenge for our credit union. And as you look at new products and services, you look at digital delivery, you look at how do we become more operationally efficient in the back office, it's going to take some strategy around, do we create a buy, build, or partner type of strategy? And we polled some credit unions at our Discovery Conference a couple of years ago. And again, about 58 credit unions that were in the session of all sizes, and asked them, when you move forward and you think about your managing operating expenses as you grow, are you looking to, and you think about new products and services and operational efficiency, are you looking at a buy, build, or partner strategy? Almost 60% of those people we polled said, we're partnering. We're going to go out and find, and again, it goes back to my talent management comment. It costs a lot of money to bring in somebody that's fresh out of MIT to come in and be work in your IT department or work in your cyber department. It's going to be very difficult. You can get those people, but they're going to come at a cost. And having the internal talent to be able to do those things might not be there. So rather than build the infrastructure to do things, partner with companies that already have the infrastructure built and they have the experts there to do it. I'll use compliance, internal audit. The complexity of internal audits have become so huge in the last 2 or 3 years, that many credit unions, rather than try to create risk management departments, are outsourcing internal audit to other firms that have the expert in each one of those categories: BSA, lending, deposit ops, whatever, Reg CC, whatever it happens to be. They've got those experts within those categories. And then the credit union has somebody in-house to be that linkage between the internal audit function and the supervisory committee or audit committee, whatever you have. And it's saving them money. It's more efficient, and it's saving them money by outsourcing that function. So that's just an example of when we think about that partner, the partner aspect of that. Vermont credit unions, not terrible from an operating expense ratio, not terrible. I mean, you're just above 3%. You bumped up close to, I mean, you were 377 in 2018, but compared to the rest of the country. And I think what's happening here too is larger credit unions, the billion-dollar credit unions, have much lower operating expense ratios. So when you take all of the Northeast and you start factoring in those large multi-billion-dollar credit unions that are in the Northeast, that's what's bringing this number down. You don't have those multi-billion-dollar credit unions in Vermont that's helping to offset some of the higher ratios. So I think that's what we're seeing here. But again, 3% is not a terrible operating expense ratio. And that gets us to our net income, 110 basis points. Again, based on what we thought was going to happen with delinquency and its impact on the provision expense, we thought that was going to be probably like a negative 10 basis points of ROA when this whole thing started 18 months ago. So because of the lower operating expenses, the being able to manage the margins relatively well, a lot of those things have helped drive, and the average asset growth has helped drive a net income and ROA of 110 basis points, 134 basis points through the first half of the year in Vermont. I mean, that's outstanding. And you've always been that 70 to 100 basis points in ROA. So even with the higher operating expense ratio compared to the New England and compared to the Northeast, you're still pretty solid as it relates to return on assets. But you pull out your fee and other income, your non-interest income, you go from 134 basis, or let's use an entire year, 2020, 0.99 basis points, 99 basis points of ROA. You pull that out, you pull out fee and other income, you're now negative 55 basis points. So that really shows the importance of finding sustainable non-interest income, creating a better mix of non-interest income to help support times like this when the interest rate environment is such that we really can't drive a whole lot of yield. Because when we want to get more yield, the only two ways you're going to get more yield in this environment is take on more risk, take on more credit risk, or take on more extension risk. So those are the things that we really need to think about. So just kind of tying things together, just some highlights of what we think are the key bullets from 2021 into 2022. Everything that I just talked about, the long-term rates, unemployment, loan growth, interest of the margins. We're not going to see a whole lot of difference, I don't think, through in the very strong economic growth. I'm guessing that it might be mid-year before we start seeing that, but we'll see. And I will say the net interest margin, rather than go all the way back, 2.55% margin. Remember that slide, the lowest ever? When you ask Mike Schenk or Steve Rick where they think the margin is going to be in 2022 and in 2023, so far it's been about 2.6% is what they're thinking as an industry. So not sure what you're targeting in your credit unions, but as an industry, they're thinking we're going to be in that 2.6 range for a net interest margin. And I put this in here just as a takeaway. We talk a lot about the impact of COVID and what's happened out there. And I would suggest that if you haven't had your planning session with your senior team or your board, use this to kind of get a sense as to get a pulse on where are people thinking where we're going to be 5 years out. Low market interest rates. Is it a temporary or permanent issue? 1 being it's temporary, 3 being it's permanent. Impact of the credit union, management focus, a 1 or a 3. So, and then you kind of get people to go down that list and rank these things and come up with, Steve calls it a freakout score, but get a sense as to where are people's heads as it relates to we come out of the pandemic and how it's going to change our strategic plans moving forward beyond just interest rates, looking at consumer behavior and looking at operational efficiencies. So again, I apologize that we couldn't do this live in person, but if you want, if you have any questions beyond this, please, there's my email, there's my phone number. Feel free to give me a call. I love talking about this stuff with credit unions. So I wish you all the very best as you go into your planning or through your budgeting process, and wish you, everyone and your families, a very happy holiday season. Thank you.